Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'm going to interject my financial opinions as we go through it. It's going to be related to three different topics: wealth building, commodities, and or financial topics. So let's dive right in. Let's take a look, see what people are sharing, and I'll throw my opinions in there as well. If you want to follow me, it's at @Finance. And if you want to join our community, finding-value.com, that's where I dive deeper into all of these topics and figure out ways to basically play this commodity bull market that we are in and the precious metals bull market that has just started with the market conditions changing. So I'm always looking for potential investment opportunities, finding the undervalued sectors, looking at undervalued companies that have huge asymmetric opportunities. So if that sounds interesting to you, we've got a question and answer session that's going on right now. The question and answer session starts at 7 a.m. Mountain Time and usually ends at around 11 a.m. So let's dive in here. Let's take a look. We've got Jordan Roy, Brian, however you say his name. Over 100 replies and all negative on miners. Two reasons why miners have done poorly. Intro of gold ETFs and secular bear market in gold, 2011 to 2023. Check how miners performed in 1960 to 1980 and from 2001 to 2011. It's perfect sentiment. Gold entering a secular bull, and everyone knows miners suck. Uh, that's exactly where the opportunity is at, guys. In fact, when you look at some of these mining companies, XAU divided by gold, this is, let me get off logarithmic here. This is the downtrend line that we just recently broke. Last bull market, we went from 1996 peak all the way downward in a flag pattern and broke downward during last bull market. So from 2000, we went from 2000 to 2006. That was the bull market here in a large downtrend fashion. We are coming from really low levels, and I think it would be a large mistake to not get some investment in these at the point way down here where we're basing at a very low level. This level is in fact cheaper than it was in the 1960s and 70s, which means that the gold and silver mining companies are cheaper against gold than basically any time in history. That's called an opportunity. And you cannot get sucked into the sentiment and become part of the herd. You have to think differently. You have to pull yourself out of that herd. Look at the data. And this data is suggesting that the downtrend line is broken and that this here is an incredible opportunity for investment over the next decade plus. So there's your opportunity in gold and silver mining companies. And the sentiment is still really bad. According to Jordan and all these other guys posting on Twitter. And what they're saying is gold all-time high, Barrett Gold 1950 versus its all-time high of $54. It's all about the market conditions that is going to create this opportunity. The market conditions that we just went through was high inflation, but the inflation was occurring on the service side too. So the costs of the miners are going up the same time that the cost of or the price of gold is going higher. What's coming is this move of gold divided by the United States Consumer Price Index. This is your miners. The opportunity here is absolutely unfathomable because what we're doing is we're breaking against inflation here. That's the miners' margins. So the incredible opportunity did not exist in these market conditions here. That's a big cup and handle if you want to know. There's your cup, there's your handle, and it's broken to the upside already and running. It's already in motion. People just don't realize it. Last big bull market was from the 60s all the way up to 1980s, early 80s. And then we've got, you could draw this across here, and we've got a gigantic cup and handle and another cup and handle in it, ready to break all of that. This is going to be probably the largest, best opportunity that anyone has seen in anyone's lifetime that is younger. The older generation, maybe the baby boomers and older, saw this. This is coming, guys. It's going to be a big breakout, and it's going to break this 1, 2, 3. It's a triple top that we've got that's going to break to the upside for gold and silver mining companies, which follows gold priced in the consumer price index. This is going to be such an incredible setup. And if you guys want to know companies and how to invest in this, sign up to the website. Ask me questions. Why would I invest in this? What are royalty companies? Should I go into speculative companies? You can ask the group, the community, all of these questions. I can't give you advice directly, but I can obviously share my opinions of what I'm doing and how I'm playing this bull market that is coming up here. Here's GDX. GDX is the gold mining companies. He says it's probably nothing. Obviously, he's joking. We're breaking out of the downtrend line here right now. This is an excellent opportunity to evaluate the potential investment opportunities that are ahead of us. And with the market conditions coming into a potential slowdown, yield curve uninverting, stuff like that, unemployment rate going up, those are all very supportive of gold and silver going higher. That's when they go up. And we've got a perfect opportunity here where the sentiment is still garbage. That's the opportunity. At the moment, the burden of proof fell upon the bears and the bulls won in terms of silver. This is the silver quarterly log chart that we've broken out of. That's the handle portion of it that we've been breaking to the upside. And then we've got a quarterly price about $32 that we need to break and get above for a quarterly close to activate this big 45-year cup and handle pattern. We've got upside momentum that's being generated here, and we could see a very big move in silver. The conditions are also, the market conditions are also ripe for this to occur under. It's an uninversion of the yield curve, a slowdown, unemployment rate going up. All of those things are tailwinds behind gold and silver at this time. This guy says no recession this time, question mark. Says typically a drop in industrial production accompanied by rising unemployment has always indicated that the economy was either heading into or already in a recession. So far, this cycle looks different thanks to AI, question mark. Here's the unemployment rate. That's that unemployment rate turning up almost every time. I think every time in history when this unemployment rate turns above about 5%, it triggers what's called the SOAR rule. The SOAR rule there's a calculation that the SOAR rule does that says that there's a very high likelihood that a potential recession could occur. And that trigger point is right at that level right now. RevCap says, everyone continuing to freak out about a recession is why we can't have one. A 3.9% 10-year yield at a 7 to 8% deficit spending during the peak of a cycle, trough unemployment, peak margins and demographics, and then the trough of housing supply is very loose. Stop bidding duration, please. It says, where art thou, recession? So there's an opposite take on a recession inevitability. We're going through a time frame of demographics that are very strong and will support the housing market is so long that it's affordable to buy it. I think I'm in the middle camp here where we could get a slowdown. They lower interest rates. You want to watch the housing starts. And if the housing starts come back, I think you'll have your answer. Because if they come back and we go into a housing market boom, which I think is a very high likelihood with home builders continuing to move up, I think that's what we're going to see. So a potential slowdown, they're going to lower interest rates. We could get a little bit of volatility during that lowering of interest rate. We need to watch the housing starts. If the housing starts move on up, there's your sign. We're going to see strength if we're in this demographic that he is talking about, which I think we are. Cuppy says the rich apparently don't mind 65% taxes as long as they don't get arrested for liking the wrong tweet. The 0.1% refugee crisis is only starting. So that's in UK to lose the most millionaires by 2028, says the UBS. Swiss Bank issues alarming outlook for the wealthy in the Britain, but the flight of non-doms is only a small factor. But they are starting to monitor and enforce things that people write, I guess, on social media. And then there's things that can occur to those people. And they're also taxing their citizens quite heavily. Time to send it, and this is silver chart. That's that big cup and handle pattern. This is just another handle portion of it. We've broken that out. We've done a retest back to these highs and lows there of support. I think it's time to go here, guys. I think we could see a big move in silver. Gold's already moving up. That's our leader. Silver's going to follow and be a lot more volatile. Everything is in alignment for silver to rip here. Here's the accumulation cylinder update for GDX, GDXJ, the gold and silver mining companies. We now embark on a 2 to 3 month of euphoria to points 8, 9, and 10. So this is the accumulation cylinder. There's 7 points in the accumulation cylinder, 1, 2, 3, 4, 5, 6, 7. Then we break from point 7 way up out of the cylinder to point 8, a small pause, point 9, and then this could be a potential double top to point 10, and then this is your bull trap, 11 and 12, and then the move lower. This here is more or less your stock market psychology. Smart accumulation in the beginning, institutional in the middle, and then the retail jumps in at the end. And this is your accumulation cylinder that he is maybe thinking is a potential 1, 2, 3, 4, 5, 6, 7, and then the break higher here with a breakaway gap for GDX, GDXJ, the gold and silver mining companies. Looks absolutely fantastic. We've got Marlum. Bore Drilling anticipates that nearly a third of the global shallow water rig fleet will be retired in the coming years due to aging, driving up daily leasing rigs. So old rigs getting retired, and it tightens up the supply. And where I think the demand is going in drilling is going to be way higher. I think Bore thinks that as well, and that's where your day rates move. It's a squeeze on the volume of rigs, the supply demand of rigs. Unusual Whales. Kamala Harris will call for the construction of 3 million new housing units in her first 4 years in office, as well as new tax incentives for builders that construct properties for first-time homebuyers. That is generally seen in an expansion phase of real estate. The real estate becomes, we'll call it, the affordability of real estate becomes really tight. Then government tries to help first-time homebuyers with all these incentives to buy. I think there's another incentive that they're talking about, like $6,000 incentive to have kids per kid, I think, or something like that, and then $25,000 for potential new home buyers that they're talking about as well. Here's another one. This is the gold to silver ratio. It's coiling up here. We're at the upper end of this. Now, here's the thing. We could get a false breakout. If there's a slowdown, gold could outperform silver in the first portion of that slowdown, which it's doing right now. Then when silver gets activated, which I think it's doing at the moment, that's when it really runs. So we're at the beginning stages of a potential big move, even in the gold to silver ratio. I think this is going to go lower where silver is going to outperform, but we could see a false breakout to the upside first before that occurs. Logan says, remember, they're still working on projects that started 2 years ago, and the backlog timeline to finish is historically high. This is why the labor is still there and has been growing in 2024. That has limits, though, as units are being completed. So this is all employees residential. We got a lower print on housing starts today. It was down about 14-15%. But state employees, residential building construction, all employees continues to go up because there's a lag behind that. But if we continue to go lower in housing starts, that can have an impact going forward on construction employees. And this here, this construction employees, whenever they roll over, that is generally where you get your recession. The unemployment comes from building construction. Jesse Colombo says gold is finally breaking out after consolidating all summer. I believe it's the real deal this time, assuming spot gold closes above 2480, which we're at 2550 today, and it isn't slammed down. I believe that gold will rally several hundred points from here to at least $2,800 an ounce. And there's the breakout there, clear as day. Building permits also lower. A lot of people talking about housing starts. I posted this one. Building permits, which leads housing starts, is down. It's at 1.396 million permits. So generally this front runs the housing starts, and you can see that we are down in permits too, which is not a good indicator for strength. But what I'm looking at is what are interest rates doing, mortgage rates more specifically, and how is that affordability going to impact permits? That's kind of what I'm watching at this time. And we're right back to about the average, slightly above average on permits at this moment. Peter says, today's lousy housing data reminds me of this classic paper. By the way, I keep being told that there are no imbalances in the housing market. Even if we set aside multifamily property where there's clear supply glut, doesn't the fact that single-family real home prices are 20% above where they were on the eve of the pandemic constitute an imbalance? It does. The housing is the business cycle. Edward E. Leamer. I found his work after I looked at the cycles. I said, in my opinion, that the real estate cycle is the business cycle, or the real estate cycle is really the housing starts is what leads everything. He's from UCLA. I studied some of his work, and it ties in almost to basically what I found. His background is in statistics and finance. I have a engineering, and I use statistics too, but housing is the business cycle, and that's what he found, and that's basically what I found when I looked at the data going backwards. So I was reading through his work as well. Here's Lance. So looking at the data here, it's much easier to see this through this chart. It says the state of their local new construction market, according to home builders surveyed by Zonda in July 2024. A lot of people are slower than expected and causing concern, or in the category slower than expected but worrisome. A lot of people are coming into this area over here about the overall markets, and these are focused in the high hitters were Florida and Texas. And then it wasn't as worrisome in the United States overall, the middle of the states. Cross-border capital, our latest weekly world economy nowcast, says slowing, not stalling, no recession in his opinion. This is the World Weekly Economic Activity Index, which is still about 1% GDP growth. So we've slowed down. You can see that we are kind of in this dead period. We've got a three-hump consolidation. Almost like liquidity is coming at some point in the future. But right now, we are still growing. It's not negative. It's not a recession yet. Looks like we had negative GDP growth in 2022 for a little while, and then we've come back out of it. So slowing, but not negative. Single-family housing starts are down 15% year over year. Multifamily housing starts are down 22%. There's the data there. We are coming closer to the average, which means we're not in an expansion phase anymore. We could be going and dipping into a contraction underneath the average. Warren Pies on housing. The reason I'm talking about housing so much in this clip is because that's what drives the business cycle. If we're going to get a recession, it's going to come from the housing market most likely. So housing, San Francisco starts plunged below 70,000 per month in July. This is the slowest monthly San Francisco start number since the spring of last year. Sub 70K single-family starts is contractionary and will lead to a reduction in residential construction payrolls if sustained. In other words, this level is consistent with recessions. So there's the data, guys. I mean, lowering in housing starts, and then the eventual reduction in employment is what leads to that recession if you guys are looking for that recession call. Here's Breakwave on oil tankers. He says, we expect VLCC rates to recover as we enter the fourth quarter, with China restocking and winter demand pushing the tanker sector across the board higher. The Middle East to Asia route should beat last year's high of $55,000 per day. Today, it's in the mid $30,000 per day range. We'll be watching China's crude oil import growth as a key factor. The negative mood in the tanker sector has made current low prices a good entry point for investors to capitalize on the forthcoming seasonal winter uptick in VLCC rates. So that's his opinion there, and I would agree with that. The charts don't look that bad in oil tankers. It says, I'm particularly concerned about Warren Buffett's BRKB recent reduction in tech stock holdings. This is also some of the big boys are selling their tech stocks. That's generally what you see right before a recession. These well-informed investors like Buffett are dumping tech stocks. TSM, HPQ, Snow, and Apple, big dumping in quarter one 23, quarter four 2023, and quarter one of 2024 here. They're all getting dumped. And just recently, quarter two, Snow and Apple. Celsius Energy, after today's EIA reported natural gas storage withdrawal, inventories have now climbed by just plus 1,500 billion cubic feet this season, falling below 2021 for the smallest to date build in the last 5 years. In comparison, storage had already climbed by 1,608 by this time in 2019, the 5-year high. So we're actually on the low end for accumulated injection of natural gas versus the previous 5 years. Here is, if you followed me for any length of time, you know my theory that one way the central planners mess with the price of oil is to transfer currency strength to Mexico from Canada. China may have figured out that game. In May, something big happened. Then it happened again on August 5th. China bought Mexican bonds, ? This is really messed up with the VIX when they did that. So I was reading some articles on Twitter about the potential of the Federal Reserve messing with financial instruments. And then messing with financial instruments were holding the price of oil lower and potentially some other things lower, but it was blowing up other commodities in other areas. This is kind of what I think China has been doing, is they're also messing with certain things, currencies and bond markets that blow up certain commodities too. And we're seeing these large volatile days occur when they start to mess with things to see how this market is interconnected. So I wanted to talk about that because this guy brought it up, and I've read it in other areas that the Fed's been doing weird things to try to hold prices down, but it causes dislocations in other areas of the market. Like cocoa, for example, I know there was a supply shortage there, but I mean, that was a pretty drastic move. But there was some dislocations that could occur. This is AI power center demand forecast for data centers. The Goldman Sachs estimate, and you can see that it just goes from left to right. Big power generation demand coming from AI data centers. What's going to supply this power here is my question. My guess is probably going to be natural gas and maybe a little bit of coal if they keep some of the coal power plants running. But I don't think uranium can catch this before 2030, the nuclear power plants. Here's a quote by John Templeton, who's a very famous investor. People are always asking me where the outlook is good, but that's the wrong question. The right question is, where is the outlook most miserable? And I would even extend that further and say, where is the outlook the most miserable, and where do we see a turning point for that sentiment to change? What is the cycle coming due? And right now, that's gold and silver, and the mining companies for sure. And that's where we're going to end it there, guys. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you're interested. We've got that question and answer session that's occurring from 7 a.m. Mountain Time to about 10, 11 a.m. Mountain Time. You can show up and ask me whatever questions you like. If you want to ask questions, what do I think the best gold and silver mining companies are? I'll share my answers there. It's also on the website. All of those, you can see my portfolio and what I'm invested in and all that stuff. So that's all I've got for today. We'll catch you next time. This is Finding Value.